Good morning, and thank you for joining us to discuss UGE International's first quarter fiscal 2021 financial results. On the call today, we have UGE CEO Nick Blitterswyk and UGE CFO Marissa Lauder. During this call, all participants are in a listen-only mode. Following the presentation, we will conduct a question and answer session. You can submit your questions through the Q&A tab on the top left-hand side in the web portal at any time. Before management discusses the results, I'd like to remind everyone that certain statements in this call may be forward-looking in nature. These include statements involving known and unknown risks, uncertainties, and other factors that could cause actual results to differ materially from those expressed or implied in our forward-looking statements. For caveats about forward-looking statements and risk factors, please see our MD&A for the year ended December 31st, 2020, which can be found on our company profile at sedar.com and on the company's website. I will pass the call over to UGE CEO Nick Blitterswyk.
Thanks, Marcel. First off, I would like to welcome everyone to the call and thank you for joining. My name is Nick Blitterswyk, CEO of UGE, and I am joined by our CFO, Marissa Lauder. For this webinar, first, I'm going to run through the agenda and let you know where you can find additional information. Next, Marissa will run through our first quarter 2021 financials and how they relate to the business. I will then provide an update on our project development backlog, take a look at one example project, and then touch on the subsequent events and other business updates that occurred after the close of Q1. We will then take questions and wrap up the webinar. As a reminder, you can submit a question through the portal on the left-hand side of your screen. As always, our goal is to be mindful of your time and keep this webinar concise and to the point. We will be speaking relatively high level and focusing on the areas that we feel are most important to understanding our results and the business. We also want to remind our listeners that we report in US dollars, so the results in this webinar are represented in US dollars as well, unless addressed otherwise. Although we will keep things fairly high level, our website address is listed here as well, where you can download our full financials. So with that, I'll turn it over to Marissa to start by discussing our Q1 financials.
Thank you, Nick. Good morning, everyone, and thank you for joining us today, so shortly after our year-end discussion. I'm going to briefly review our financial performance, our financial position, and our cash flows. So taking a look at slide 4 and starting at the top, our 3 operating solar facilities in the US generated 103 kilowatt hours of electricity, generating $26,000 in revenue in the quarter. It should be noted that there is seasonality associated with energy production, and all else being equal, we would expect higher production in Q2 and Q3. The operating solar facilities are producing within our expectations. Moving down, we earned $398,000 in EPC and consulting revenue in the quarter. This is consistent with last quarter, but as expected, due to the changing business model, this was lower than the $640,000 we earned in the same quarter last year. And as mentioned at year-end, until we reach scale in operating solar facilities, we will continue to see our top-line revenue pressure. This is why we are super focused on growing our backlog and moving projects efficiently through to operating status, so we can reach scale in our operating solar facilities to get to a solid base of recurring revenue from energy production. This transition will lead to a certain period of accounting net losses, but it's important to note that projects can create positive cash flows through the development cycle, which Nick will demonstrate later in this presentation. And this is despite the accounting revenue not being recognized until the project is operational. Moving on, operating costs were $1.2 million in the quarter, up from $1.14 million last quarter. Costs are increasing in line with the addition of origination and development staff to support our growth targets. We will see measured growth over the next few quarters as the full effect of the additional staff is absorbed. Overall, the GAAP net loss for the quarter was $1.07 million compared to GAAP net income of $132,000 last quarter. Last quarter did include $934,000 in gains from debt settlements at a discount and $105,000 in COVID relief income, compared to only $41,000 this quarter in gains on debt settlement and $33,000 in COVID relief income. So considering these adjustments, on an adjusted basis, net loss was $1.15 million this quarter compared to a adjusted net loss of $0.91 last quarter. Now, moving to the next slide, let's take a slightly deeper look at our financial position. From a high level, we can see that our assets increased by almost $3 million from the end of 2020, while our liabilities increased by about $1.8 million. We've made good strides in improving our financial position in the quarter, and with the funds raised in the February private placement, we ended the quarter with $3 million in cash and positive working capital of $547,000. I want to note that included in the calculation of working capital are 3 current liabilities that will not or may not need to be settled in cash. Specifically, $537,000 in convertible debentures with a conversion price of 96 cents Canadian, $295,000 in construction debt, which will roll over to project term debt once the project is complete, as well as $1 million in contingent liabilities where the ultimate cash outflow, if any, is unknown at this time. Moving down the page, we continue to grow our construction in progress as the current project under construction nears completion. Solar facilities in use have declined slightly from accounting depreciation, and our right-of-use assets from leases and the related liabilities grew as we signed 2 new leases in Q1 2021. And finally, on the asset side, project development costs increase as we continue to build the backlog of projects. Trade payables decreased significantly as we paid some amounts in the normal course, but we also prepaid at a discount the amount due from the Canadian EPC proposal that we discussed last quarter. And finally, with the addition of capital from the private placement, we ended the quarter with positive shareholders' equity of $419,000, up from a shareholders' deficit of $4.3 million at the end of 2020. Moving to the next slide. This is a condensed view of our cash flows for the quarter. As you can see, we utilized significant cash in the quarter. In particular, we settled accounts payable and trade payables, which includes the prepayment of the proposal amount already mentioned. And we also settled $806,000 in debt with cash, as well as $588,000 with equity, which is not included as a cash outflow. These payments are non-recurring cash outflows, and we expect to see a more normalized cash outflow as we move forward. That concludes my remarks for today. Thank you for your time, and I will turn it back to Nick.
Thanks, Marissa. As you know, tracking the growth and maturation of our project backlog is an important part of our business. On this slide, we show the backlog table as of March 31st. First, we grew the backlog by about 10 megawatts in Q1 as additional projects were secured. As we note in our MD&A, the broader pipeline also grew and now sits at almost 180 megawatts, or at least it did as of March 31st. With a backlog at over 70 megawatts, we believe we are tracking well towards our 120 megawatt goal by the end of 2021. Second, in terms of maturation of the backlog, we had 359 kilowatts of solar facilities reach stage 5 in Q1, meaning that they are in construction. We also had 741 kilowatts of solar facilities become fully contracted and permitted. We expect those projects to jump to the phase in just the timelines in Maine have been variable. In essence, solar is growing quickly in the state, and the 2 main utilities are behind schedule in providing final sign-off on interconnection applications. Taking the 2 together, we are expecting at least 5 megawatts of projects to reach stage 5 this year, ahead of what we expect to be a significant ramp in 2022. A couple other notes on our backlog. One, I want to note that the timing of each stage is by no means equal, which is important as you track the progression. Stages 3.1 and 3.2, where we work to secure interconnection agreements with the utility, are the slowest for ground-mounted projects, which currently take up a fairly significant portion of our backlog. On the other hand, typically you would expect projects to progress quite quickly from stage 3.3 to stage 5. That last pre-operation stage, which is when the project is actually built, will often last 2 to 4 quarters, during which we are building up the solar asset on our balance sheet and earning the developer fee. Second, A reminder that this table only includes our self-financed projects. As of the end of Q1, we had 3.3 million of client-financed opportunities in the deployment phase, the majority of which is a portfolio of solar plus battery storage projects in New York City that are just starting construction now. Lastly, just a reminder that since we started reporting on backlog, we've used discount rates of 10% for non-operational projects and 8% for operational projects. These are arbitrary discount rates, and we often get asked about the sensitivity to discount rate changes. We looked at a couple example projects ahead of this webinar to confirm current sensitivities, which are currently approximately 5%. In other words, decreasing the discount rate by 1% would yield an increase in present value by about 5%. Next, we wanted to look at one sample project to show how its results impact our financial statements, because from questions that we've had from investors and so on, we know that this is not always perfectly clear. In this case, this is the Brinks Springfield Gardens project that became operational in December. The project is a warehouse for Brinks, of course, near JFK Airport in Queens, and it's for a repeat client of ours, which is the real estate developer with which we have developed a strong relationship. The project has a rated capacity of 196 kilowatts, and as of March 31st, had a backlog value of $416,000. I will note that this project is on the smaller side for us, and in fact, it's typically below what we consider our minimum at this point in time. Because smaller projects are generally quicker to develop and build, our first self-financed operational projects have on average been smaller to start with, but that will scale as more projects are installed. On the next slide, first we look at the balance sheet where we see the numbers from our Q1 financials. The solar facility asset is $315,000, which is a number that we carry at our cost. Just to give a little more detail on that, you see $319,000 in brackets. So that was the number before the first quarter of accounting depreciation. And also this project had a New York State grant of $115,000, which the way the accounting works on that is subtracted from the cost base, leaving as of March 31st, the $315,000 as our solar asset. This solar facility has a long-term project debt of just over $214,000, as well as a tax equity accounting liability of $137,000. As Marissa discussed on our year-end webinar, according to IFRS, tax equity transactions are treated like debt for accounting purposes. Looking at the income statement, this project generated just under 30,000 kilowatt hours, which resulted in $8,800 in revenue for an average of 29.5 cents per kilowatt hour. New York City residents pay some of the highest costs for electricity in the US, and community solar is one way to provide these residents with cheaper, clean energy at a rate less than the grid. In this case, we are offering 10% discounts to grid rates. As you can see here, the quarterly lease amount was $1,575, and there were no other operating costs in the quarter. Lastly, if we look at cash flow, we see two things. First, as we talk about elsewhere, we earn a developer fee as a project is constructed. In this case, we earned about $63,000 during that time. Although this is cash to UGE, it is not revenue on the income statement, as you can see above. In Q1, keeping in mind both the smaller size of project and the seasonality in the Northeast that Marissa mentioned, we netted about $3,500 in cash flow from the project. So although this project is on the smaller side, we hope that this illustration will be helpful in how projects flow through our financial statements. Note that by looking at our backlog table, you'll see that this project is about 1/9 the average size of the projects that are currently working their way through the development stages. So lastly, since the close of the quarter, we've remained busy and have a few additional points to mention. The first was closing on a tax equity transaction for the under construction Westchester project that is expected to reach commercial operation in the next month or two. We are also currently in the market for tax equity on the next two New York rooftop projects and have been quite pleased with the options available to us. As a reminder, when we refer to tax equity transactions, these are transactions that are used to monetize the investment tax credit in the US. Secondly, we've added significant talent to the team in the last few months. The bulk of these additions have related to our origination and development efforts as we look to grow our backlog to 120 megawatts this year. I'm excited to report that the new members of the team are already working to close their first deals. Lastly, we noted in our subsequent events in the financial statements that we have signed 2 additional leases since the close of Q1 for upcoming projects. This includes our first site in Pennsylvania, a state we look forward to discussing further through the course of the year. So with that, we'll wrap up the prepared remarks by pointing you to where you can find more information. As mentioned earlier, our website is regularly updated. It contains all of our financial filings and other updates. You can also visit Sophic Capital's website for additional information. You can also follow us on Twitter to get links to announcements and other media. Thanks again for tuning in today. Marcel, back to you.
Thank you, Nick. We've collected the questions investors have submitted since issuing the financial results this morning. We've also collected the questions submitted through the web portal's Q&A tab. We'd like to thank participants for your questions, and you can continue submitting them through the Q&A tab. Moving to our first question. Can you provide color around the factors that have driven the increase in your expected backlog capital expenditures?
I'll try to take that, and Marissa, if you have anything to add as well. I think that in terms of our backlog and expected capital expenditures from our year-end table versus our Q1 table, I don't have this side by side right in front of me, but there's nothing material that comes to mind in terms of changes. This does lead me to go down a path. There has been commentary in the solar market recently about increases in capital expenditures on these projects. So I'm happy to discuss that too. I just want to pause and just see if Marissa has anything to add on the first point.
No, Nick, I think you handled it. Thank you.
Yeah, you bet. So just in case other people have that on mind, there has been commentary recently about increasing costs of equipment, and so from our perspective, we are in procurement on a few projects right now, both in the U.S. in particular, and I believe some in the Philippines as well. And we have seen some increase in solar panel costs. We haven't seen any material increases in the other costs. We haven't actually been in the U.S. In the market for much labor of late, so I can't say that we've seen an increase in that or not. But certainly from our discussions, we see all of these types of things as being sort of within the normal course of business. The other thing I'll say is, as we're budgeting for our projects, we hold contingencies. We have many suppliers we work with, and so on. So as of today, there's certainly no material disruption in the supply chain or cost that we see.
What is the greatest challenge to executing the backlog of finance projects more expeditiously?
Expeditiously, I think that the main thing that comes to mind there, Marcel, is just that they take time. I think generally speaking, we talk about an average 2-year turnaround, and then in recent quarters we've gotten a bit more granular to say, for a rooftop project, which tend to be on average smaller than ground-mounted ones, you see that time frame be about 9 to 18 months, and then for the ground-mounted projects, you might see 18 to 36 months. So coming out at an average around 2 years. So with that in mind, we of course, the vast majority of our backlog was either secured last year or now this year, and so with that in mind, we're just working it through the steps to get there. And so it's going to take some time, but we have, as we've talked about before, over 400 megawatts of experience doing this type of work, and so we'll stay focused on moving those projects through. In the prepared remarks, I did mention, like, for example, in Maine, the timelines that were in essence promised by utilities have not been kept, which I generally link to the growth in the market in that state, and so that is a challenge in the short term. But in the medium to long term, we see it being kind of coming out in the wash as we work towards our more medium term goals.
Can you walk us through how your cash position is impacted before a project becomes operational? I'm concerned that you don't have enough equity on the balance sheet to execute your backlog.
Well, I think that as you asked that question, I'm thinking to myself, that would have been an additional good aspect to add to that example project earlier, because as we're moving these projects up towards NTP, which is the start of stage 5 or when deployment or construction starts, as we move projects towards that, the actual expenditure is very low compared to the size of the overall project. And yeah, so with that in mind, the actual working capital need in developing the projects is quite light. As projects get to NTP or even something before that, like when we're closing on the construction debt, which, as we mentioned earlier in the talk about the working capital position, flips into permanent debt in all of our cases as of now, as the project reaches operation. So we get the project funded by third-party sources as we reach that NTP, and at that point in time, it actually turns working capital positive, right? So we talked about the developer fee that we take out of the projects as we build them out. So yeah, so I don't think it's right to link our equity position with the working capital needs of building out the backlog specifically.
Can you illustrate how much a tax equity sale is worth and how it is recognized as revenue? Say you use a $1 million cost project in the illustration.
I think from the accounting perspective, because the word revenue there was used, Marissa, are you able to take that?
Yeah, and I want to be clear. It depends a lot on how the tax equity is structured. But let's just take a theoretical example. And if you think about tax equity, we're really selling a value that we currently don't have on our balance sheet. So while we don't recognize revenue as we amortize the liability, part of the rundown in that liabilities does go through other income. So not top line revenue, but other income. But part of the rundown in liability is also sharing of cash flows with the tax equity investor. And that's very unique to the actual individual contract with the tax equity investor. So I can't give you a number in general, but I think it would probably be worthwhile if at our next webinar, we walk through a tax equity example with different cash sharing assumptions. But it does create some other income when the tax liability runs off. I hope that helps.
Address the major difference. Oh. Yeah, we'll see if we get a follow-up question on that. Could you address the major differences in IFRS accounting standards and typical accounting as it pertains to UGE?
Yeah, I'll take that. I don't think there is anything unique about the way UGE accounts for things under IFRS. I will say from a complexity perspective, certainly the tax equity accounting is unique in the industry, and how that is treated from an accounting perspective is different than what you would normally see. Understanding what goes into the accounting values is important too, meaning what is in our capital assets and how those are treated. It requires some reading of the financial statements. For example, Nick already talked about how when we receive government grants that help us build a solar facility, that reduces the value on our balance sheet. And so understanding that that's not revenue, where in the past we might have recognized that as revenue if we didn't own the asset. So that is a little bit different as well. Those are really the two major areas where you get some complexity in the application of IFRS.
Back in mid-November, you sold a small pre-operational project for $2.30 per watt, which is consistent with how you value your current backlog. I appreciate your model is to develop and own assets long-term, but have you had any confirmation of the market value of your backlog by way of any offers to buy some of your backlog assets?
Yeah, first I'll take that. I think that that sale in the fall was certainly not unique from an industry perspective. I would say that at this point in time, certainly across the not just the leadership of the company, really across the company, we have a lot of network ties and are constantly in the market understanding where things are at. So that project is certainly representative of another project of that type. That was a New York rooftop community solar deal. Just to I'm trying to think if there's anything else to add there. I think that Yeah, maybe I'll leave it at that. If there's follow-up questions on that, I can take it as well.
You are guiding 100 megawatts of operational solar assets in 2024. What would this be worth in recurring revenues?
Yeah, I can take that, and I think that just to as of right now, of course, UGE we don't forecast results. So what I'll do actually, if I just go back to the backlog table here, so the 70 megawatts that we had as of March 31st, and I'm just realizing I apologize, but the table says March 31st, 2020. That should say 2021, and I think that's my fault for taking an earlier table, but the average annual recurring revenue here is just over 12 million, and it would be reasonable to assume that if you prorated that up to 100 megawatts, so we're talking about 1.5 times that, so we would be at, call it 17 to 18 million in recurring revenue at that 100 megawatt mark.
Yeah, and I just want to clarify one thing on that, Nick. It might be helpful as well, is that the recurring revenue in the Philippines is a different revenue recognition model, and so it's better to get, if 100 megawatts was in the U.S., it would have a higher recurring revenue. So just be careful in understanding the difference between the Philippines and the USA. And so in the Philippines, given the structure of the agreements in the Philippines, UGE doesn't actually own the underlying solar facilities. It manages them and it operates them, but it doesn't technically own them. And so what happens in the Philippines is we still earn upfront revenue, and the remaining recurring revenue is actually financing income, because we finance the solar facilities for the customers who technically buy the solar facilities. And so that is financing income and servicing income, and it's a little bit less than what we would earn on generating electricity, and it's also not variable with the generation of electricity. So that 12 million that you see there in recurring revenue, if it was all in the US, it would be higher.
Are all of your growth plans organic?
So as of right now, all of the growth we've been experiencing has been organic, and we're really heads down on continuing that path that we're on. So we've talked a fair bit at this point, with regards to the returns we get. I think that's been a good basis, part of the conversation here for doing that. I think it's probably fair to say that in our investor presentation and so on, we talk about how this market that we're in is still quite fragmented. A common approach to like the industry is developers that develop and flip projects, and so in that regard, we do see opportunities for us to partner with other developers, acquire projects from other developers, things like that, and still add value to our to our business model in other non-organic ways. I think that it's fair at this point to say that there are opportunities like that out there, but that our 120 megawatt goal this year, for example, is all based on organic growth.
Once you scale and reach the annual recurring revenue numbers in the millions, what sort of gross and net margins do you expect to achieve?
Mercer, feel free to add more on this, but I know that of course, different projects, et cetera, but gross margins on that recurring revenue, we're expecting to be north of 75%.
Yeah, Nick, that would be right. That might be a bit conservative, but that's what we use to plan.
Can you talk more about why you've moved into Maryland and Pennsylvania?
Yeah, those are two different answers. So in Maryland, there's an established community solar program that works, I think, really well for the types of projects that we do best in. And by that I mean the community solar program there has a cap of 2.5 megawatts AC per site. It matches very well with where our comparative strength is. We've also done having an LMI, or low and moderate income aspect to these programs, is fairly common in terms of the energy offtake. And in that regard, the Maryland program has a certain carve out for those types of projects. and so on. It's obviously a state here in the Northeast and one that is fairly easily reachable from where our staff are. So that's Maryland. And that program, I forget exactly what year that came in, but it's been around for a couple of years at this point. And so we're excited to be growing in that state. Pennsylvania is a bit different in the sense that, and I may bungle my regulatory lingo here, but there's regulations that have passed or legislation that's passed that a community solar program is coming in. So for example, actually, we've signed a lease in Pennsylvania. We touched on that earlier. That project is we're preparing for that program to be passed, and so that one would be pipeline but not backlog. It might be a good example of that. This was post March 31st. It was a subsequent event. But Pennsylvania we see as another good state nearby. Obviously, there's some large cities with large energy demand in like Philadelphia and Pittsburgh, obviously, and so on. So we see that as a really good growth market for us in the coming years.
Do you plan to add more development resources through the rest of the year?
Well, that actually gives me a chance probably to elaborate a little bit more on the growth we've had so far. So we, in no particular order, but we brought on a senior level person from in New Jersey from one of our competitors here. We actually have a resource in Pennsylvania now in a nice sort of tidbit of how the industry is going. He joins us actually from land acquisition and oil and gas. So glad to have him come over to the bright side, if you will. We've let me see. So we've added a couple other people in the development origination side of things. And actually over in the Philippines, we've added business development staff there too. So we added quite a bit over the last few months, and I touch on this both in the prepared remarks and also in the investor newsletter, that we're seeing really good traction from new members of the team. And so we look forward to that becoming a bigger story as more of those projects drop down into backlog through the months and quarters ahead. All that's to say is that we had a hiring plan that we put in place within Q1, and the majority of those hires have already been made certainly on the development side of things. And so really right now it's the team's really gelling and coming together, and we're seeing good progress. So that's a very long-winded answer. I apologize for that. But the point being is, we had certain hires we wanted to make, and in most cases we went out and made them.
Do you think larger solar companies will become more active in community solar?
Yeah, generally speaking, yes. I think it's a very good market. I think that in our investor deck, as an example, we have a graph in there of some projections around the size of the community solar market. If I remember the numbers correctly, I think that the total market in 2020 was about 3 gigawatts in the U.S., and the projection that we took from one study was 57. I saw it by 2030. I saw another graph recently from I know this one was from Wood Mackenzie, and this one had kind of 3 scenarios, and the top scenario was over 80 gigawatts, and I don't remember the other two, but it's a good graph that we can share with anyone who's interested too. Point being is that there's a lot of growth here, so that's good for us. We were very early in community solar. We're the first ones developing a project in New York City of that type, and one of them, if not the first, in Maine. So it's a type of project that we know really well. But also, of course, it's going to attract some of the other companies too. So we see names like SunPower. We've seen on some much larger deals that we've looked at before. We haven't seen any of aside from SunPower, we haven't seen any of the other residential providers in community solar yet. NextEra is a name on the utility scale side that we've seen a little bit as well. But yeah, I think it's fair to say that as this market grows, that you'll see additional companies come and take a look. But we'll be looking to capture our fair share, of course.
Based on your current backlog and when products are coming online, what will your cash balance look like as you exit the year?
A couple of things I'll note on that is, number one is that we don't provide forecasts, right? So I'm not going to put a specific number on it. Marissa touched on this in the opening remarks, but in Q1 I'll call it strategically, cleaned up the balance sheet is the term I'll use, right? So we went through that earlier. And yeah, I think that if you look at our overhead on that earlier chart, if you strip out the non-cash and mostly share-based compensation, the quarterly overhead was a bit under $1 million, and the cash balance was a bit over $3 million as of the end of Q1. So we're focused hard on reaching our goals here of scaling up the backlog, getting projects into the point of stage 5 deployment when we start earning our developer fee, and starting to see a more positive cash impact as more projects are built out. Which I talked earlier, 2022 is going to be a year where we see much bigger ramp ups as more of this backlog that, of course, is still on our slide here, starts to be built out and become operational.
Can you walk us through the cash demands off your balance sheet through each stage, 3.1 to 6?
Yeah, okay. Let's see. So and it's not perfectly clean, I'll have to say. So up until stage 3.1, when we get binding commitment, the development expenses that we pay, and I'm ignoring here staff costs, but in terms of development costs to get to the binding commitment, it's very negligible. Once we get projects into these stages 3, this is where we start aspects of and this is not true for every project, but interconnection is certainly an aspect of it. Structural review for buildings, permitting, and some land studies like wetlands and things like that for ground mount projects. That's where we start to spend a bit of money before the project reaches that stage 5 of deployment. I mentioned earlier, and I want to say this again, as projects go through the development stages, by no means are these stages meant to be equal amounts of time, right? You'll see projects hang out in 3.1, 3.2, they break through, they have the interconnection, and projects should therefore get into deployment. So those next 2 stages, we typically don't see as being as long. We have a rule of thumb that we've used before that is for $1 million of backlog, so call that 500 kilowatts of being about 20,000 in development expenditure. That's from looking at a few sample projects. It definitely varies. And I think I'd be remiss not to say, so 500 kilowatts, 20,000, 1 megawatt would be about 40,000. So you could apply the math as these things are built out. On the flip side though, again, once projects get into construction, we would typically first close on the construction financing and then tax equity. I want to say some of these development costs do get bundled into the construction phase of things too. In particular, some aspects of the interconnection. So, maybe to a fault because the projects vary, and that's why we try to give some examples of specific projects like we did. But that gives you a sense in terms of like on a per megawatt basis how those numbers flow.
How do you view share-based compensation as a means to incentivize employees?